Hello and welcome to this session in which we will keep working in Chapter 10, making capital investment decision. And under this section, we're going to look at two topics, which is one of them is net working capital and the other topic is depreciation. But what I'm going to do in this session, I'm going to break it down into two sessions. I will cover the net working capital first, then I will cover the depreciation. So far, we just took net working capital at face value and we did not really analyze it. So let's go ahead and start to analyze net working capital and how does it affect our cash flow. So far what we have did in calculating cash flow, we did not explicitly consider that some sales might be on account. So every time we looked at sales, we assumed that all the sales are in cash. That's not really true, okay? So we did not explicitly consider the fact that some of our sales might be on credit. Also, we may not have actually paid some of our costs. Also, when we incurred costs, we did not took into account that those costs are accrued. In other words, they're not paid now, they're going to be paid later. In either case, the cash flow in question would not yet have occurred. So there's no cash flow if we did not receive the cash or if we did not pay for the expenses. We show here these possibilities are not a problem as long as we don't forget to include the change of net working capital in our analysis. So now we're going to be adding the change in net working capital in our cash flow analysis. Okay, it's very easy. And if you remember your cash flow statement from Accounting 101, then that should be easy, but I'm going to go ahead and explain this concept again. So suppose during a particular year of a project, we have the following simplified income statement. We have sales of 500, cost of 310. Sales minus cost equal to 190. Now, what do we need to know? Well, we need to know that this is from the income statement, therefore we're using accrual accounting. What does that mean? It means this 500, some of it might be cash, and some of it might be on credit. So when we sold $500 worth of merchandise or worth of services or worth of whatever we are selling, sometime we're going to receive cash, sometime we're going to receive credit. So we need to know how much of the sales, not necessarily sales, how much is cash in. It's going to be cash, and how much of it's not cash, because when we do our cash flow analysis, we are only interested in one thing and one thing only, and that's cash. Cost 310. Remember that some of it could be paid and some of it is accrued. If it's accrued, it's not paid yet. So we need to figure out how much of the sales is cash and how much of it is not cash. In other words, how much did we receive in cash and how much did we pay out in cash? Because what matters in a cash flow analysis is cash in and cash out. That's what we care about. So we need to convert sales into cash in and cost into cash out. Okay, and for this example, depreciation and taxes are 0, so we are not including depreciation and taxes to keep this example simple. In the next session, we would look at depreciation on its own. No fixed assets are purchased during the year, also to keep it simple. Also, to illustrate the point, we assume that the only component of net working capital are account receivable and account payable. So here we go. So we have account receivable at the beginning of the year, $880. At the end of the year, 910. So here's the beginning account receivable and here's the ending account receivable. So let's analyze account receivable separately first. So account receivable went up. How much did it go up? It went up $30. Why did it go up $30? Because you're telling me in the prior year when I started the year, I had $880 in account receivable. Now I have 910. Now, what is account receivable? So we need to know what's account receivable. Account receivable is sales made on credit. It's a promise from customers. We had $880 promises and now they're 910. So the promises from the customers to pay went up because we made more sales on credit. To be more specific, we made more sales on credit. How much more? $30 more. Now, how do we interpret this information when it comes to sales? Well, here's what we are told. Here's what's happening here. We are told in this example that sales is 500, okay, which is it's giving right here. Then what we are told, account receivable went up $30. What does that mean? Well, if account receivable went up, it means some of that sales was on credit. How much of it? $30 was on credit. So if I take 500 minus 30, It's 470. It means cash received is only 470. So although I made sales of $500, but the cash received from those sales is 470. How did I know this? Because my account receivable went up. Now, if you want to work a different example, and let's assume you started the year with 880. Okay, let's change the numbers now. You started the year with 880, but you end up the year with 800 in receivable. It means the change was negative of 80. So account receivable went down by 80. What does that mean from a cash flow perspective? Going back to this example, what we say, this is again, I'm changing the scenario here. If account receivable went down, it means we collected more cash. It means, so if account receivable went down, we add $80, therefore it's 580. This is the cash in, 580. Why? Because we made sales of $500 and account receivable went down. It means we even collected more receivable from prior years. Therefore, cash in is 580. So what we can say is when account receivable increases, subtract from sales, and when account receivable goes down, add the difference to sales to come up with your cash. So this is what you need to know. And by the way, this formula applies to all assets, and specifically, since we are working with net working capital, we're only working with current assets. Current assets. What does that mean? It means if inventory went up, you subtract from sales. If inventory went down, you add to sales. And any other current assets, such as prepaid assets. If you have a prepaid assets, they work the same way. If they go up, it's a subtraction to sales, or cash in. Well, forget about prepaid. We don't want to go into, because we don't use them. So keep them out. Okay, so this is what we need to do. This is what we need to do, but the concept applies to all current assets. Okay, so here's what we did. Now we analyze current assets, specifically account receivable under current assets. Now we're going to go ahead and analyze, since we're done with account receivable, now we're going to analyze our accounts payable. Okay, accounts payable went from $550 to $605. What does that mean? It means our accounts payable simply went up by $55. What does it mean that your accounts payable went up? It means you purchased more on account. What does that mean? It means you are not using cash. Well, what does that mean from our analysis? Well, let's look at the cost here. The cost is 310, and what we care is we need to go ahead and convert the cost into cash outflow. Cost is 310, but my accounts payable went up. It means I did not pay cash. It means I can subtract $55 from that amount. So if I take 310 minus 55, it means I paid 255 cash out. Why? Because I recorded 310, but $55 of it was on account. It means my cash out is only 255. That's what it means. Now I can change the scenario. Let's assume now, we'll change the scenario. Assume that accounts payable went from 550 to 600. I'm sorry, 550 to 500. It went down. Now we're changing the scenario and assuming accounts payable went down negative 50. Well, what does that mean? If your accounts payable is going down, it means what? It means you are paying off. You are paying off accounts payable. Well, what does that mean from our perspective? It means your cost was 310. Then in addition to the cost, you paid off $50 of account receivable. It means your cash outflow is 360. That's what it means. Well, what can we say? What we can say about accounts payable, if accounts payable goes up, it's a subtraction to the cost. If accounts payable goes down, it's an additional outflow to the cost. Okay, so this is what we can say about accounts payable and cost. So this is the formula that we will need to use. So let's go ahead and basically this is how you analyze the change in working capital. Okay. So based on this information, what's the total cash outflow for the year? We can first just mathematically apply what we have been discussing to come up with the answer. So remember in chapter 2 we learned that operating cash flow is the same as EBIT because there are no taxes or depreciation. Thus, it's equal to 190, which is 190 plus minus 215 equal to 215. Okay, but let's do it the way that I did it earlier. What did I do earlier? Earlier, I said cash flow from sales. So let me figure out this 215 the way that I showed you. What I started, I took $500. Let's go back to the original data. I took $500 and I subtracted $30 from it, and that gave me $470. Then I took the $310, which is the cost. Then accounts payable went up. I subtracted 55 from it. Go back here. 310 minus 55, 255. Now if I take 470 minus 255, and that's going to give me 215, which is what I got the same here. But all what I did in this calculation, I explained why did I come up with 215 by analyzing account receivable and accounts payable separately. This is what I meant to say by we need to take a closer look at net working capital to see what is leading to the change of net working capital. And if you look at this, if you look at the analysis here, if you read the analysis below, it's going to get you the same thing. Okay. To determine cash revenues, we need to look more closely at net working capital. During the year, we had sales of $500. Account receivable increased by $30. What does that mean? You need to subtract the $30. And for the cash outflow, we started at 310. It had increased by 55. It means we only paid 255. Okay. So all in all, 500 minus 30, 310 minus 55. What we end up is 215. And this is this is the whole explanation that I did earlier. Okay. Now, let's take a look at another example to consolidate what we have learned, to kind of work it in an example. So this is for the year just completed. CWT reports sales of 998 and cost of 737. You have collected the following beginning and ending information from the balance sheet. We have account receivable, which is an asset, current asset, inventory, which is an asset, and accounts payable, which is a liability. Let me put the liability in a different color, liability. So those are your net working capital. First, calculate the change. Account receivable went up by $10. Inventory went down by $20. And accounts payable went down by $30. Based on these figures, what are the cash inflows? What are the cash outflows? What happened to each account? What's the net cash outflow? Okay. So now we have to take a look at what we have and do what? Analyze it using the same techniques that we used earlier. Let's start with sales. Sales is 998. Then account receivable went up. It means I need to subtract $10 from sales. So that's going to be 988. Okay, so sales were 998, but receivable rose by $10. So cash collection were less than $10 less than sales, so 988. Excellent. So I just converted 998 into 988 by subtracting the $10. Now costs were 734. So costs were 734. but inventory went down $20. What does it mean inventory went down? It means I'm not replacing my inventory. I'm not buying more inventory. It fell by $20. So what does that mean? It means I did not replace it. I mean, I can deduct $20 from my inventory. If I am not replacing, if I'm not buying inventory, that's more cash in my pocket. Okay? Notice too that accounts payable went from 100 to 70. Accounts payable went down. What does that mean? It means I am paying off my accounts payable. If I'm paying off my accounts payable, I need to add $30. Why? Because it's a cash outflow. Remember, cost is an outflow. Okay, so 734, I started with cost given to me in the example. I purchased less inventory, which is -20, then I paid off more accounts payable, which is a plus, but which is an outflow. The plus is an outflow. So 734 minus 20 plus 30, which is basically add 10 to it, because these will add up to be a 10. So 744. So the cost converted to cash is 744. So basically 988 minus 744, which is going to give me what I'm looking for, 244 as the net cash outflow. 244 is the net cash outflow. Now earlier I said something that I'm going to need to go back and clarify. In the prior, when I explained inventory, I said inventory work with sales, and this is true. Whoops, this is true. So what I said here is true, but in this textbook they analyze inventory not with sales, they analyze it with cost. So I need to make an adjustment. So when you're analyzing inventory, if inventory goes down, if inventory goes down, it's basically, it's a less, so it's a plus to the cost, because cost is an outflow. And here's what we did in this prior example. We said cost was 734. We said cost was 734, and inventory from the prior year went down by 20. So what we did is we subtracted 20. Subtraction of 20 means this is an increase in cash flow, because this is an outflow. This is a negative. Okay, cost is a negative. This is cost. And what I'm doing is I am reducing the outflow. It means I'm increasing the inflow, which is worked the same way as if we took the $20 and we added it to the inflow of cash. 734. Okay, so this is what we did. And when inventory goes up, we add it as a negative. So if inventory went up, it will be, let's assume it went up by 20, it will be plus 20. Therefore, the outflow will be 754. Okay, so keep that in mind. We would have got the same answer if you used my formula too. If you used my formula, if you took sales was 9, after adjusting for account receivable, was 988, because remember we started at 998, then we subtracted $10, so we end up with 988. And what we can say is, since inventory went down, that's an additional $20. So if we added $20 here, or we subtracted $20 from the outflow of cost, we will get to the same answer. But since they're analyzing inventory in terms of cost, use this formula rather than this formula, analyzing inventory in terms of sales. So I'm glad, they used it differently, so I'm glad I clarified this point. So let's go back to that exercise that we were working. Basically, we finished it, but let's go ahead and summarize it. Okay. So finally, notice that net working capital increased by 20 overall. We can check our answers by noting that the original accounting sales less cost are 264. In addition, CWT, which is spend $20 on net working capital, so the net results is 264 minus 20. So what we could have done is, rather than analyzing each account separately, we could have said net working capital went up Okay, so what we can say is we could use what we learned in chapter 2. We can take 998 minus 734. Let's do this. 998 minus 734. This is accrual. This is 264. Then, since net working capital went up, it means we spend $20 minus 20 will give us 244, which is the same answer that we got after we did all the analysis, breaking each account separately. So all what we did here is we are analyzing and studying how each component of net working capital affect cash, starting with inventory, starting with receivable, inventory, and payable. Or in chapter 2, what we did is we only took the change here and we said if it went up, subtract, if it went down, add. All what we did here is we're analyzing each account separately. So it's something that we learned, just now we broke down into how we came up with the $20, how we came up with the decrease of the $20. Okay? And it's right here. It is right here. Plus 10 minus 20 minus 50, they were, remember that the 20 is in the cost, the decrease of 20 is a positive, therefore we'll end up with an increase of 20. So that's basically what it is. If you have any questions, any comments, by all means, email me. The next thing we're going to look at is depreciation.